You know, it's a funny thing about human nature. If you think about it, you probably have a fire extinguisher somewhere in your house right now,
Oh, yeah, definitely.
right? Like maybe it's tucked under the kitchen sink or maybe it's mounted out in the garage behind some boxes.
Gathering dust?
Exactly. It's bright red, it's heavy, it takes up space, and you bought it with the absolute fervent hope that you will never, ever have to pull the pin and actually use it.
Right. You hope it just sits there until it expires and you have to go buy a new one.
Yeah. But you have it. And why do you have it?
Right.
Because the cost of not having it, if, say, a stray spark hits the living room curtains well, the cost is total devastation.
Total catastrophic loss.
Yeah. And it's the perfect analogy for what we're looking at today.
Yeah.
Because we buy these physical tools to protect our physical assets, but we seem to have this massive blind spot.
A huge blind spot. When it comes to protecting the invisible engine that actually funds all those physical assets, you know, our ability to generate income.
Exactly. So today we are looking at the ultimate financial fire extinguisher. We are diving deep into the 2026 Life Insurance for Families Guide.
Buy life insurance.
Right. And our mission for this deep dive is to take a topic that is, let's be honest, uncomfortable.
Very uncomfortable. Morbid, even.
Yeah, morbid and generally just avoided at all costs. We want to completely demystify it. We want to move family life insurance out of that mental category of like an intimidating chore I'll get to eventually.
Right. And place it firmly in the category of an empowering financial tool.
Yes, an empowering financial tool. And we're going to start with a reality check from the source material that, honestly, it stopped me in my tracks.
You're talking about the LIMRA data, aren't you?
I am, yeah. According to the LIMRA 2024 Insurance Barometer Study, 44% of U.S. households would face financial hardship within just 6 months if a primary wage earner passed away.
Yeah.
I had to read that twice, like 6 months.
It is a staggering statistic when you really sit with it. I mean, 6 months is nothing.
It's 2 seasons.
Exactly. It's 2 seasons of the year, you blink, and 6 months have passed. And what's even more concerning is that if you have young children in the household, the data shows that financial cliff approaches even faster.
Wait, faster than 6 months.
Oh, yeah. Often within just a month or two. Because what we're really talking about here is an incredibly fragile equilibrium.
Okay, unpack that a bit. What do you mean by fragile equilibrium? Because I think a lot of people feel like they're doing okay financially. You know, they pay their bills on time.
Sure. But most families are operating on a financial tightrope, even if it feels like solid ground to them.
Right.
They're balancing their incoming cash flow directly against their outgoing structural expenses. So the mortgage, the car payments, the groceries, utilities, student loans, it's a very delicate ecosystem.
Yeah, it's all mapped out.
Right. So when you remove the primary earner, you don't just remove a person from the dinner table, you completely remove the structural foundation of that entire financial ecosystem.
It collapses.
It does. The shock isn't gradual, it's immediate. I mean, the mortgage company doesn't...
$25. Okay, I really want you, the listener, to hear this. That is less than what most families are spending right now on their monthly streaming service subscription.
Oh, easily.
You are talking about trading the cost of, like, binge watching a few shows on a Friday night for a $500,000 safety net for your children.
It's wild when you frame it like that.
It really is. You desperately hope you never have to use it, just like the fire extinguisher under the sink. But the financial barrier to entry is almost non-existent for what you're actually getting.
Exactly. The real cost of not having the coverage vastly, astronomically exceeds the cost of maintaining it.
Right.
If we connect this to the bigger picture, the mechanism of life insurance is essentially just the transfer of catastrophic risk. That's all insurance is, really.
You're offloading the risk.
Right. You are paying a tiny, highly manageable, predictable premium to transfer the utterly unmanageable, unpredictable risk of your family's financial ruin to a massive institution that can handle it.
Okay, so replacing a wage earner's paycheck, that's the obvious part of the equation.
Right.
If someone brings home the money and they're gone, the money stops.
We all understand that math. It's visceral.
Yeah, it's visceral. But as we transition into the actual economics of a modern household, the research points out that the most disastrous financial blind spots often lie where there isn't a traditional paycheck at all.
Ah, yes.
And I think this is where a lot of families get completely derailed.
We need to talk about the invisible earner.
The stay-at-home parent.
Yes. This is perhaps one of the most critical and, unfortunately, most frequently misunderstood concepts in all of family financial planning.
Totally.
The materials we're looking at make it absolutely unequivocal. Both spouses need significant life insurance, even if only one of them works outside the home and receives a W-2.
Okay, I'm going to push back here.
Yeah.
Because I can hear a listener thinking right now, because it's the absolute most common reaction.
Oh, I know exactly what they're thinking.
Wait a second, if there's no income to replace, why on earth would I buy a policy?
Yeah.
If my spouse stays home with our toddlers, we aren't losing a salary if they pass away. My salary's still here. My paycheck still clears. Why am I paying an insurance company to replace an income that doesn't exist?
Right.
So what does this all mean? How do we reframe this for the skeptic?
It's a totally valid question, and it requires us to completely reframe the conversation. We have to move away from the concept of replacing salary and move toward the concept of funding replacement services.
Funding replacement services.
Yes. A stay-at-home parent is an economic engine in their own right. They are providing enormous, tangible, highly skilled economic value to the household every single day.
Yeah.
Salary.com actually ran the numbers on this recently. They do an annual survey calculating the market value of a stay-at-home parent, and they found that replacing the services provided by that parent would cost between $40,000 and $80,000 every single year.
Wow. Depending on the region and the kids' ages, right?
Exactly.
Let's really dig into that. 40 to 80 grand. What does that actually represent in the real world? Because I think people hear that and think, okay, sure, babysitting.
Oh, it's so much more than babysitting.
Right.
It represents an incredibly diverse array of full-time, professional-grade labor that is currently being done for free.
Yeah.
If the stay-at-home parent tragically passes away, the surviving working spouse is suddenly hit with a logistical and financial nightmare of epic proportions.
Total nightmare.
Think about it. Who is providing the full-time childcare while the surviving spouse is at work? You now have to pay for a high-quality daycare center or a full-time nanny.
Which is incredibly expensive.
Exactly. Who is handling the after-school programs? Who is doing the transportation to and from soccer practice, piano lessons, doctor's appointments?
Right.
Who is doing the household management, the deep cleaning, the grocery shopping, the daily meal preparation, the laundry, the general family coordination?
It's the invisible infrastructure of the family. It's the operating system that keeps a whole machine running smoothly.
Precisely. It's an operating system that requires 40 to 80 hours of labor a week. And here's the crucial mechanism that people miss. The surviving spouse cannot simply absorb these tasks.
Right, because they're already working.
There are only 24 hours in a day. The surviving spouse is likely working 40 to 50 hours a week just to provide the actual cash flow that pays the mortgage.
Yeah.
If they suddenly have to take on the role of the stay-at-home parent as well, they are faced with a physically impossible choice.
Right. They either have to drastically reduce their own working hours, like maybe step down to part-time, which immediately reduces the family's income and might cost them their health benefits.
Exactly.
Or they have to pay out of pocket for these replacement services on the open market.
And paying out of pocket for a nanny, a house cleaner, an after-school transport service, that $40,000 to $80,000 a year will drain a family savings in a heartbeat.
Oh, absolutely.
The surviving spouse will bleed cash every month just trying to keep the kids fed, clean, and safe while they are at the office.
So buying a policy for the stay-at-home parent isn't about replacing a W-2. It's about ensuring the surviving spouse isn't forced to quit their job just to keep the household physically running.
Exactly.
It's about buying the surviving spouse the ability to keep working. It buys them the capital to hire a nanny so they don't lose their career on top of losing their partner.
What's fascinating here is how this shifts our whole perspective on family economics. It acknowledges that it takes 2 full-time jobs to run a modern household with children.
Yeah, that's a great way to put it.
One job might generate cash and the other might generate services, but structurally, both are functionally indispensable. You cannot run the household without both.
And if we look at dual income families as a contrast, the underlying principle remains exactly the same, just with slightly different math.
Right, because in a dual income family, both of those incomes are usually baked right into the family's lifestyle.
It's not like one income pays all the bills and the other is just fun money for vacations.
No, not usually. When you go to the bank to get a mortgage, they look at both incomes. Your debt-to-income ratio is calculated on the combined cash flow of the household.
Exactly. The mortgage payments, the car loans, the standard of living, the neighborhood you live in, it's all built on the foundational assumption that 2 incomes will continue indefinitely.
Right. And the materials note that losing either income stream in a dual income household would be devastating. It would immediately throw the household into a severe deficit.
So both partners need meaningful coverage.
Yes. The specific amounts might differ, sure.
Yeah.
The higher earner typically needs a larger death benefit for pure income replacement, while the other spouse needs enough to cover their specific proportional contribution. But the necessity of coverage is universal.
Okay, so we've established the baseline. Both partners need a safety net, regardless of who brings home the actual paycheck. But that brings up the million-dollar question sometimes, literally.
Literally, yeah.
How much? If you're sitting at the kitchen table on a Sunday afternoon, you got a notepad out, and you're trying to figure out exactly how large that net needs to be. Where do you even start?
Right.
Do you just pick a number that sounds good? $500,000? $1 million?
People do that all the time.
This leads us to what the guide calls the DIME method. And I love this because it takes something vague, emotional, and overwhelming and makes it incredibly systematic. D-I-M-E.
It's brilliant.
I want to break down each letter extensively and really understand the mechanics of this math. Let's start with D.
The D stands for debt. And specifically in this context, we are talking about all outstanding non-mortgage debts.
Okay.
This is the first layer of vulnerability for a surviving family. We're talking about credit card balances, auto loans, personal loans, and critically, student loans.
Why do we separate this from the mortgage? Why is consumer debt the first thing we look at?
Because consumer debt is toxic to cash flow.
Oh, that's a good way to phrase it. Toxic to cash flow.
It demands high monthly minimum payments. If a spouse passes away, the very last thing you want is the surviving partner to be saddled with paying off a car they might not even use, or drowning in the monthly minimum payments of $20,000 in credit card debt while trying to navigate life on a single income.
Right.
You want to calculate the exact dollar amount required to write a check and wipe the slate completely clean on all consumer and educational debt. Imagine the relief for a grieving spouse to never receive another credit card bill or car loan statement again.
Okay, so D is debt. Get rid of the immediate monthly bleed, calculate exactly what it takes to hit zero on everything except the house.
Yes.
Then we move to I, which stands for income. Now, the guide says you should take your annual gross income and multiply it by 10 to 15 years.
Right.
I'm going to stop you right there because 15 years of my salary is a massive number. That's millions of dollars. I can hear listeners balking at this thinking, that feels excessive. That feels greedy. Why is the multiplier so high?
This raises an important question, and it's the exact point where people usually experience sticker shock.
Oh, massive sticker shock.
Why 10 to 15 years? Well, you have to understand the mechanism of what this money is actually doing. It is not just about immediate short-term survival.
Right.
A life insurance payout isn't just supposed to get the family through the next 12 months of groceries. It's about providing a long, secure runway.
A runway. I like that. Explain the runway.
It provides the surviving family the financial space to fundamentally restructure their lives. Grief is debilitating. It changes people.
Yeah.
The surviving spouse might not be able to work at their previous capacity for a year or two. They might need to change careers to be more present for their children.
That makes sense.
If you have a toddler, 10 to 15 years of income replacement gets that child completely through middle school or high school without the surviving parent having to take on a stressful second job or drastically downsize their living situation or pull the kids out of their school district. Yeah. It removes the constant, suffocating pressure of financial ruin during the absolute most vulnerable years of child rearing. It's not greed, it's structural stability.
It's buying time. You're literally buying your family a decade of financial peace of mind while they figure out their new normal.
Exactly.
Okay, I get it. The sticker shock is real, but the logic is sound. So D is debt, I is income. The M stands for mortgage.
Yes, the full remaining balance of the home loan. The goal here is simple but profoundly impactful: to ensure your family can stay in their home completely debt-free.
Let's talk about the mechanics of that, because housing is typically the largest single expense in any family's budget. It's the anchor.
Precisely. It's the anchor expense. If you can use a portion of the life insurance death benefit to completely pay off the mortgage, you instantly and permanently reduce the surviving family's required monthly cash flow by thousands of dollars.
Thousands.
Even if they are living on just one income now, the fact that they no longer have a $2,000 or $3,000 housing payment every month makes that single income stretch incredibly far.
Wow. Yeah, that changes everything.
Furthermore, it secures their physical sanctuary. When children lose a parent, their entire world is upended, forcing them to also move out of their family home, leave their neighborhood, and change schools because the surviving parent can't afford the mortgage that just compounds the trauma exponentially.
That's heartbreaking to even think about.
Right. Paying off the mortgage stops that secondary trauma.
Securing the physical sanctuary. That's a really powerful way to frame it. And finally, we have the E, which stands for education.
Right. The guide estimates current college costs at anywhere from $100,000 to $250,000 per child.
Per child, wow. Depending on whether we're talking about state public universities or private institutions.
Okay.
So if your long-term plan as a parent was always to help your kids through college so they don't start their adult lives buried in student loans, you have to account for the fact that your future earnings, which would have paid for that, are now gone.
So you add that projected tuition cost into the bucket.
Okay, so let's actually do the math on this. Let's walk a hypothetical family through the dime method so you, the listener, can see the mechanics in action.
Okay, let's do it.
Imagine a family earning $80,000 a year. Very typical middle-class scenario. They have a $350,000 mortgage on their house. They have 2 kids. And let's say they have $40,000 in other debts, maybe a car loan and some lingering student loans. Let's build their dime profile.
Okay, let's break it down. D, the debt, is $40,000. We put that in the bucket.
Got it.
I, the income.
Okay.
Let's say we do a middle ground multiplier of 12 years on that $80,000 salary. 12 times 80,000 is $960,000. That goes in the bucket.
Yeah, okay.
M, the mortgage, is $350,000. And E, education. Let's say they want to provide $100,000 for each of the 2 kids. So that's $200,000.
So I'm adding this up. 40,000 plus 960 plus 350 plus 200. That comes out to $1,550,000. Over $1.5 million.
It adds up fast.
And the guide notes that depending on inflation and specific college goals, that number easily stretches to $1.8 million.
And this is where the reality check hits hard. For many people, making $80,000 a year, hearing that they need nearly $2 million in life insurance, is terrifying.
Yeah, it sounds like an impossible, unapproachable number.
They think, I'm not a millionaire. How can I possibly need a multi-million-dollar policy? The source material explicitly notes that relative to this precise dime standard, the vast majority of American families are drastically underinsured.
It's a huge number. And I know there's another way people calculate this. You often hear financial advisors on TV or like on TikTok giving a much simpler rule of thumb.
Oh, the 10x rule.
Yeah. They say just multiply your gross annual income by 10 or 12, and that's your number. So for that same family making 80 grand, the simple rule of thumb says they need between 800,000 and maybe $1 million in coverage.
Right.
But the dime method pushes them closer to 1.6 or 1.8 million. That is a massive gap, almost double. Why the discrepancy?
It highlights the exact difference between generalized, lazy advice and personalized structural planning.
Lazy advice. I like that.
The 10 to 12 times income rule of thumb is an okay baseline if you're just starting the conversation. It will generally yield a coverage amount between $500,000 and $2 million for most middle-class families. But here is the critical flaw in its mechanism.
What's that?
It completely fails to account for the specific, unique liabilities of your family. It doesn't care if you have $5,000 in credit card debt or $50,000.
Right.
It doesn't factor in whether you've been in your house for 20 years and your mortgage is almost paid off, or if you just signed a massive new mortgage yesterday. It treats every $80,000 earner exactly the same.
I look at it this way. It's the difference between building a structural bridge and just throwing a plank of wood across a river.
Oh, that's a great analogy.
The dime method is engineering a custom bridge. You're calculating the exact load-bearing weight of your mortgage, the specific tension of your consumer debt, the span of your children's education. You know exactly what it takes to keep the bridge from collapsing.
Yes.
The 10 to 12 times rule is just guessing how thick a plank needs to be. It might hold you, but if the wind blows or you're carrying a heavy load of debt, it's going to snap.
Yeah.
One is mathematically exact, the other is just an approximation.
That's a perfect way to visualize it. If you want to know with absolute certainty that the mortgage will be cleared, the specific debts wiped out, and the specific tuition funded, you cannot rely on a shortcut. You have to do the granular math of the dime method.
But here is where we hit a massive psychological wall.
The cost.
The cost. A $1.8 million requirement sounds completely unapproachable. How does a normal middle-class family afford to buy a multi-million-dollar safety net?
Well, the answer, according to the source material, depends entirely on the type of policy they buy.
Which brings us to the heavyweights of the insurance world. Term life versus whole life.
Yes. This is where we transition from bankrupt. The guide contrasts three main types of insurance: term life, whole life, and indexed universal life, or IUL. And for the vast majority of families, especially young families with children and mortgages, the guide is very clear. Term life insurance is the undisputed gold standard.
The gold standard.
Okay.
Let's dive deep into term life. Explain the mechanics to me. What makes it the go-to recommendation for almost everyone?
It comes down to incredible mechanical efficiency. Term life is exactly what it sounds like. You are buying coverage for a specific period of time, a specific term, usually 20 or 30 years.
Right.
It is pure insurance. There are no investment bells and whistles. The reason it is so highly recommended is that it provides the highest possible death benefit for the absolute lowest premium dollar.
Okay.
Going back to our very first point, securing $500,000 for $25 a month is only mathematically possible with a term policy.
Because you're basically renting the coverage, right?
Exactly. You're renting it.
You're paying for pure protection during the years your family is the most vulnerable. Let's play this out. You buy a 30-year term policy when you're 28 years old. You have a new baby, a new house. By the time that term expires, you're 58.
Right.
Ideally, your kids have graduated college and are financially independent. Your mortgage is either paid off entirely or significantly paid down. And you've had 30 years to build up your own 401k and retirement savings.
Exactly.
You simply don't have the same massive liabilities anymore.
Right.
You don't need a $1.8 million life insurance policy at age 60.
Precisely. You've hit on the core logic. The logic of term life aligns perfectly with the typical arc of family financial liability.
Yeah.
Your liabilities look like a mountain.
A mountain.
They peak when your children are young, your debt is high, and your mortgage is new. Then, slowly over decades, that mountain shrinks. Term insurance is designed to cover you while you're standing on top of that mountain of risk. The premiums are fixed, the coverage amount is completely clear, and the payout is guaranteed if you pass away within that specific window of time. If you outlive the term, the policy simply expires and you stop paying.
Okay, so if term is the gold standard for most, where does whole life fit into the picture? Because I have to bring this up. We all know the stereotype.
Oh, the salesman's stereotype.
Everyone has that guy from high school, right?
Yeah.
The guy who got a job in financial services and immediately slid into your DMs trying to sell you a whole life policy.
Yes, everyone knows that guy.
There's a lot of skepticism and, frankly, some hostility around whole life because it often feels like a high-pressure sales tactic. But the guide calls whole life the best option for long-term wealth building. So what are the actual mechanics here? Why is it pushed so hard, and what does it actually do?
I'm glad you brought up the stereotype because it's real and it makes people defensive. The reason whole life is often heavily pushed by salespeople is that the commissions on it are significantly higher than on term life. That's just a reality of the industry.
Wow. Okay, that explains a lot.
However, we shouldn't dismiss the product itself because it serves a very specific mechanical purpose. Whole life is an entirely different vehicle than term.
How so?
Term expires. Whole life is permanent. As long as you pay the premiums, the policy remains in force until the day you die, whether that is tomorrow at age 40 or decades from now at age 104.
And that changes the math for the insurance company.
Drastically. With a term policy, actuarial data tells the insurance company that the vast majority of people will outlive their 20-year term.
So they don't have to pay out.
Right. The company will likely never have to pay out. That's why they can charge you $25 a month. But with whole life, the insurance company knows with absolute 100% mathematical certainty that they will eventually have to pay out that death benefit because everyone eventually dies.
Right.
Therefore, they have to charge you significantly higher premiums, often 10 to 15 times higher than term, so they can actually accumulate the funds to pay out that guaranteed claim while also making a profit.
10 to 15 times higher. Yikes. And the guide mentions it builds guaranteed cash value. I hear this a lot, like be your own bank. What does that actually mean mechanically?
Well, when you pay that massive whole life premium, let's say it's $500 a month instead of $25, a portion of that goes toward the actual costs of insuring your life. But the rest of it goes into a cash value account managed by the insurance company.
Oh.
This account grows tax deferred over time at a guaranteed minimum interest rate. Eventually, you can borrow against this cash value while you're still alive. That's why families focused on complex estate planning, generational wealth transfer, or creating a conservative, tax-advantaged savings vehicle often utilize whole life. It's forced savings combined with permanent insurance.
But there's a very specific, incredibly important nuance mentioned in the text regarding whole life that has nothing to do with rich people trying to avoid estate taxes.
Yes.
And it has to do with families who have special needs children.
Yeah.
I want to highlight this because it's vital.
This is perhaps the most crucial application of whole life mentioned in the guide. For a typical family, as we discussed, the financial dependency of children is temporary. They grow up, get jobs, and support themselves.
Right.
But for parents of a child with severe special needs, that child may require specialized care, medical support, and funded housing for their entire natural life. In this scenario, the child's dependency is a permanent liability, not a temporary one.
Which means a temporary policy is the wrong tool for the job.
Exactly. The unpredictable timing of the parent's death requires a permanent solution. A term policy that expires when the parents turn 60 is utterly useless if the parents live to be 80, but their surviving 50-year-old special needs child still requires full-time funded care.
Wow. That's so true.
Whole life guarantees that literally no matter when the parents pass away, a guaranteed lump sum of funds will be there to transition the child's care seamlessly into a trust or to a guardian.
That makes total sense. You map the mechanics of the policy to the mechanics of your life. Temporary liability gets a temporary term policy. Permanent liability gets a permanent policy.
Perfectly said.
Okay, the guide also briefly touches on a third option, indexed universal life, or IUL. This is presented as a middle ground. But the language around it is full of jargon. It says it's linked to a market index while still providing downside protection.
Right.
Explain this to me like I'm 5. How does an insurance company let me play the stock market but magically protect me from losing money if the market crashes? What's the mechanism?
It's a great question, and it's not magic, it's financial engineering. An IUL is a permanent policy, like whole life, so it has a cash value component. But instead of the insurance company just giving you a flat, guaranteed 3% return on that cash, they link your potential return to an index, like the S&P 500.
Okay, so if the S&P goes up, my cash value goes up.
Right, up to a certain cap. Let's say the cap is 10%. If the market goes up 15%, you only get 10%. The insurance company keeps the rest. That's the trade-off. But the benefit is the floor, which is usually 0%. If the stock market crashes and goes down 20% in a year, your cash value doesn't lose a single dime. You earn 0% that year, but you don't lose your principal.
How do they afford to offer that floor? Why doesn't the insurance company go broke when the market crashes?
Because they aren't actually investing your money directly into the stock market. That's the secret. The insurance company takes your premium and puts the vast majority of it into highly secure, boring corporate and government bonds. These bonds guarantee a small, steady return. The company then uses just the interest generated from those bonds to buy call options on the S&P 500.
Wait, so they're trading options with the interest?
Exactly. If the market goes up, the options pay off and you get your return. If the market crashes, the options simply expire worthless. The insurance company only lost the interest they used to buy the options, but your core principal is still safely sitting in those secure bonds. That's how they engineer the 0% floor.
Wow. Okay, that actually makes perfect sense. It's bond-backed options trading under the hood. So who is the target audience for this? Because that sounds complicated.
It is complicated. The ideal profile for an IUL, according to the source, is a high-earning, typically dual-income family who has already maximized all their traditional easy retirement accounts.
Like they've maxed out their 401ks.
Yes, maxed out 401ks, maxed out Roth IRAs, and they have extra cash they want to shield from taxes while getting some market exposure. It also offers flexible premium payments. You can pay more some years and less than others, which appeals to business owners or people whose income fluctuates heavily.
Okay, so let me put you on the spot to crystallize this decision for the listener, because I think this is where people get tripped up by the jargon and the sales pitches.
Absolutely.
If I'm a 30-something parent, I'm making median income, I have a massive mortgage, I have toddlers running around, and term life is vastly, vastly cheaper than whole life or IUL. Why would I ever let a financial advisor talk me into buying a permanent policy?
You shouldn't.
Blunt. I like it.
And this is where you have to be rigorous in your thinking. You have to strictly differentiate between what you are actually trying to buy. Are you trying to buy pure protection, or are you trying to buy a complex financial asset?
Right.
If your primary goal, and really your only goal at this stage of life, is to make sure your spouse doesn't lose the house and your kids can still afford to eat and go to college if you die tomorrow, you need pure protection. You need the massive $1.8 million death benefit we calculated earlier. Trying to buy $1.8 million of whole life coverage for a young family on an $80,000 income would be mathematically impossible. The premiums would be thousands of dollars a month. It would bankrupt you. So you buy term.
Period.
But if you have vast amounts of disposable income, your basic term needs are already completely met, and you are looking for tax-sheltered asset growth and estate planning, then you are shopping for a complex financial asset, and permanent life enters the conversation. But for the vast majority of listeners, stick to the pure protection of term.
That clarifies it perfectly. Pure protection versus complex asset. Don't mix them up if you're on a budget. All right, speaking of long-term financial planning, we've covered the parents, the wage earners and the invisible earners. But there is one member of the family that people rarely think about insuring, and honestly, it is usually the hardest, most uncomfortable conversation to have.
Oh, yes.
Let's talk about the logic behind child life insurance.
It is a highly controversial topic, and the guide does not shy away from acknowledging that. It explicitly states that parents intuitively, viscerally resist this idea.
Of course they do.
It is a massive psychological barrier. Absolutely no parent wants to spend even 1 second contemplating the death of their child. It feels morbid, and to some, it almost feels like bad luck to even entertain the thought of putting a financial value on it.
It does. It feels entirely counterintuitive to everything parenting is about. My job is to protect my kid, not profit from their tragedy. I totally get why people recoil at the concept. But the materials completely shift the paradigm here. It moves the justification entirely away from the concept of a death benefit and focuses on a radically different forward-looking reason for doing this.
Yes. The text argues that the primary overarching purpose of insuring a child is guaranteeing their future insurability.
Guaranteeing future insurability.
This is a profound shift in perspective. Insurability is essentially a fading asset. When you are young and healthy, your insurability is at its absolute peak. As you age and as life happens, your insurability degrades.
Right.
If a parent takes out a small whole life policy or adds a rider for a child when they are perfectly healthy, they are permanently locking in that peak insurability at incredibly low juvenile rates.
And this is where the light bulb goes off for me. Because what happens if that child at age 12 is diagnosed with type 1 diabetes? Or at age 16, they develop a congenital heart condition? Or what if they survive a brutal bout of childhood leukemia?
Those are the exact scenarios. If they do not have prior coverage, those health conditions could render them completely, permanently uninsurable as adults.
Wow.
Or, at best, make their premiums prohibitively, astronomically expensive. They might reach age 30, get married, have a family of their own, want to protect their own children using the dime method we just discussed, and find out they literally cannot get life insurance at any price because of a health condition they developed in high school.
That's devastating.
But if their parents locked in a policy when they were an infant or a toddler, that coverage is already in force. It cannot be revoked, it cannot be canceled, and the rates cannot be jacked up, regardless of whatever health issues develop later in life.
It's literally buying them a golden ticket for their future financial security. You are protecting the 30-year-old version of your child. And let's talk about the cost effectiveness of this, because the guide points out that you don't necessarily have to go buy a massive, expensive standalone policy for the baby.
No. The most cost-effective, frictionless approach mentioned is adding a child rider to the parent's existing term life insurance policy.
The rider?
Yes. The source notes that this is extraordinarily affordable. We are talking about $5 to $10 a month per $10,000 of coverage. And usually, one rider covers all current and future children in the household for one flat rate.
$5 to $10 a month. I look at that and I just marvel at the return on investment. You are spending the equivalent of one fancy latte at a coffee shop every month to prevent your child from being completely uninsurable 30 years from now.
It is an incredible, almost entirely invisible gift to give their future selves.
It really is. And while the text does acknowledge the morbidity, it notes the death benefit's real function in the absolute worst-case scenario. We have to touch on this.
Yes. In the tragic, unthinkable event of a child's passing, that modest death benefit, say, $10,000 or $20,000, serves to cover final expenses like funeral and medical costs.
Right.
But more importantly, from a structural perspective, it buys the family time. It allows the parents to take a leave of absence from work, to grieve, to seek therapy without the immediate compounding panic of how to pay the mortgage that month. It provides a small, necessary buffer of financial grace during the worst moment of their lives.
Buying time to grieve without financial panic. That is powerful.
It is.
Okay, so we've essentially built the ideal family insurance portfolio here. We have massive term coverage for both spouses, whether they're earning a W-2 or running the household. We have a locked-in safety net rider for the kids, and we've customized the exact death benefit using the dime method. We know exactly what we need.
The full package.
Now, let's pivot to the practical execution. Because knowing you need a multi-million-dollar portfolio, actually paying for it are two different things. Let's talk about how the listener can keep the costs of all this as low as possible over the decades. What are the strategic savings?
The guide provides a very robust set of practical, actionable tips for reducing monthly premiums. And the very first one is the most foundational, inescapable rule of underwriting.
Which is?
Buy when you are young and healthy.
You can't game the system on aging.
You cannot. Life insurance is one of the few financial products where your biological age directly mathematically dictates your cost. The rates lock in at the time of purchase.
Right.
Every single year you wait to buy a policy, the baseline cost of insurance increases simply because your statistical mortality, the actuarial probability that you will die, increases. Buying at 28 is always cheaper than buying at 35.
Okay, buy early. The next tip is bundling policies. Insuring both spouses with the same carrier often earns discounts, much like bundling your home and auto insurance with the same company.
Exactly. It reduces customer acquisition costs for the carrier, and they pass a fraction of that savings to you. And as we discussed extensively, choosing term over permanent insurance is the primary, most impactful way to keep costs manageable if budget is a tight constraint.
Now, here is a big one that deals with underwriting mechanics. Avoiding tobacco. The guide notes that smokers pay 2 to 3 times higher premiums. Why is the penalty so severe?
Because the actuarial data, again, the brutal math of when we're likely to die on tobacco use is absolute and undeniable. If you are a smoker, your risk profile skyrockets.
Yeah.
You are statistically far more likely to die during a 20-year term than a non-smoker. The insurance companies know this, and they will charge you exponentially more to take on that risk.
And people probably try to lie about it, right?
All the time. But it's important to note, underwriters don't just take your word for it. They will require a paramedical exam where they test your blood or urine for cotinine, which is an alkaloid found in tobacco. You cannot hide it. Interestingly, some carriers are starting to differentiate between tobacco use and occasional marijuana use. But tobacco remains a massive red flag that will double or triple your rates.
The text also mentions maintaining a healthy weight and blood pressure to qualify for what they call preferred rates. What does that actually mean from an underwriter's perspective?
When you apply for life insurance, you aren't just given a flat price based on your age. You are placed into a risk class based on that medical exam and a review of your medical records.
Okay.
Preferred Plus or Super Preferred are the absolute best classes, offering the lowest possible premiums. They are reserved for people in excellent health with great blood pressure, optimal cholesterol, excellent A1C levels, and a healthy body mass index.
So perfectly healthy.
Right. If your health is average, maybe your BMI is a bit high or your blood pressure is elevated, you get bumped down to standard rates, which are significantly more expensive.
So hitting the gym and eating a salad actually pays off in cold, hard cash.
Literally. By proactively managing your weight, diet, and blood pressure before you apply for a policy, you can literally save thousands of dollars in premiums over the life of a 20-year term policy simply by qualifying for that preferred tier.
The guide also gives a great administrative tip. Pay annually instead of monthly. It says doing that saves 5 to 8% on premiums. Why does the frequency of my payment matter to a multi-billion-dollar insurance company?
2 reasons. First, administrative drag. Processing 12 credit card or bank transactions a year costs the company more in processing fees and administrative oversight than processing one lump sum.
Well, that makes sense.
Second, the time value of money. If you give them the entire year's premium on January 1st, they can immediately invest that entire lump sum and earn interest on it for the whole year.
Right. If I pay monthly, they have to wait for the capital.
Exactly. They prefer having the cash up front, so they incentivize you by passing those operational savings back in the form of a discount. If you can budget to pay the lump sum once a year, it's a guaranteed 5 to 8% return on your money.
And lastly, on the tip sheet, Use an independent agent who can shop multiple carriers simultaneously. You don't want to just go to one single insurance company like the one that insures your car and take their only price.
Correct. You want an independent broker. Every insurance carrier has slightly different proprietary underwriting guidelines. Company A might be very strict on BMI but lenient on cholesterol. Company B might penalize cholesterol heavily but be more forgiving of a family history of heart disease.
Oh, I see.
An independent agent can look at 20 different companies, analyze your specific health profile, and match you with the carrier that views your specific quirks the most favorably, ensuring you get the lowest possible rate.
Now, within this section on strategic savings, there's a very sophisticated approach mentioned in the text called the ladder strategy. And I want to spend some real time here because I think this is one of the most valuable, mechanically brilliant concepts in the entire guide.
I agree completely. It's a fantastic structural tool.
So the traditional thinking is, okay, I did the dime method. I need $1.5 million of coverage. I have a new baby, so I need it for 30 years. I will go buy one massive $1.5 million 30-year term policy.
That's what most people do.
But the ladder strategy flips that entirely on its head.
Yeah.
How does it work? I want to use an analogy here. Explain it to me like the booster stages of a rocket ship launching into space.
I love that analogy. It fits perfectly. The ladder strategy is about matching your coverage amount precisely to your declining liability over time, rather than overpaying for a massive block of coverage you won't need in the future.
Okay.
Think about a rocket launching. When it's sitting on the launch pad, gravity is at its absolute strongest. The rocket is heavy, full of fuel, and it takes massive, enormous thrust to just get it off the ground.
Right.
That is you in your late 20s or early 30s. You have a brand new 30-year mortgage. You have toddlers who need daycare. You have student loans. Your financial gravity is crushing. You need massive thrust, let's say $1.5 million in coverage.
But I don't buy one massive policy. I stack them.
Exactly. Instead of buying one huge rocket, you build it in stages.
Okay, walk me through the stages.
Stage 1, the core stage. You buy a $500,000 30-year policy. That is the base. That covers the long tail of the mortgage and your spouse's retirement runway.
Got it.
Stage 2, the middle booster. You stack a separate $500,000 20-year policy right on top of it. This covers the period until your newborn finishes college and moves out.
Okay, so now I have $1 million.
Right. And then stage 3, the heavy lifter booster. You stack a $500,000 10-year policy on top of both of those. This covers the immediate, most expensive decade of early childhood, daycare costs, and your highest debt years.
So for the first 10 years, while I'm fighting the strongest gravity, I have all three policies active, giving me the full $1.5 million in thrust.
Exactly. You have maximum coverage when you have maximum liability. But here is where the mechanics of the ladder strategy save you a fortune. After 10 years, your kids are in middle school, daycare costs are gone, you've paid down a chunk of your mortgage, your 401k has grown.
The gravity is lessening.
Right. And right on cue, that 10-year policy expires. The heavy booster detaches and falls away. You stop paying for it, your coverage drops to $1 million, which is perfectly fine because your liabilities have also dropped.
Oh, wow. And then after 20 years, the kids are out of college and self-sufficient, the 20-year policy expires, the middle booster detaches. Now I'm just cruising in orbit on that original core 30-year policy of $500,000, just protecting the final years of the mortgage.
Precisely. By manually dropping the coverage tiers as your actual life liabilities decrease, you save a tremendous amount of money in premiums over that 30-year window, compared to buying one giant $1.5 million policy that you'd be overpaying for in years 20 through 30.
It's so elegant. You sculpt the insurance to match the exact shape of your financial life.
You're engineering the exact thrust you need, right when you need it.
But of course, life doesn't always go according to a perfectly sculpted flight plan. The guide stresses that life insurance is not a set-it-and-forget-it product. It is a living document, and it details key life events that should automatically trigger a policy review.
Yes, the source material explicitly lists the triggers, and they are intuitive once you understand the mechanics of liability.
But what?
You must review your policy if you have a new child that's a new dependent. If you purchase a new home, that's a massive new debt load. If you experience a significant income change, a big promotion means your family's lifestyle has inflated and you have more income to replace.
Right.
Going through a divorce or a remarriage requires changing beneficiaries and recalculating support. Approaching retirement, sending a child off to college, or taking on the financial care of aging parents. All of these alter the math of the dime method. As a general rule, the guide recommends reviewing your coverage every 2 to 3 years or immediately upon any of these major life changes.
It makes perfect sense. Let's compare two different scenarios to show why this set it and forget it mentality is so dangerous.
Let's do it.
Think about a 28-year-old. They have one infant, and they just bought a small $200,000 starter home. They do the dime calculation, and it says they need $500,000 in coverage. They buy a term policy, check the box, and feel great. But fast forward 14 years.
Right. Look at that exact same person at age 42. The math is entirely different. Now they have 3 kids instead of 1. They upgraded from the starter home to a much larger house in a better school district, and now they have a $600,000 mortgage.
Yeah.
They have an established career, and their income went from $60,000 to $130,000, which the family's lifestyle now completely relies on.
And if they haven't looked at their policy since they were 28, they still only have that original $500,000 policy.
Exactly. That policy is now hopelessly, dangerously inadequate. If they die at 42, $500,000 won't even pay off the new mortgage, let alone replace 10 years of a 6-figure salary or send 3 kids to college.
Wow.
If they haven't reviewed their policy, they are walking around exposed to massive catastrophic risk without even realizing it. They think they are safe because they have life insurance, but the gap between what they have and what they actually need has grown silently over a decade.
You think you checked the box in your 20s, but the box got 10 times bigger while you weren't looking. You have to keep pacing with your own life.
A periodic review with a licensed advisor ensures that the financial safety net you think you have is the one you actually have. It brings reality and expectation back into mathematical alignment.
Man, we have covered an immense amount of ground today. We have pulled apart this 2026 guide piece by piece. We talk about why the stay-at-home parent is a vital, irreplaceable economic engine that absolutely requires its own coverage. We broke down the granular math of the dime method to calculate exactly what a family needs to survive and thrive after a loss, building a bridge instead of throwing a plank. We weighed the pure protection of term against the complex asset mechanics of whole life and IUL.
A huge distinction.
We discussed the forward-thinking brilliance of locking in a child's insurability. And we laid out the rocket booster ladder strategy to make it all affordable.
It's a comprehensive framework. And through all of the math, the underwriting mechanics, and the strategic planning, I think the core theme remains the same. Life insurance isn't really about planning for death.
No, it really isn't. It is about guaranteeing the financial trajectory of the people you love most, regardless of what happens to you. It is the ultimate act of taking responsibility for their future. It's building the moat around your castle so that even if the worst happens, the walls stay up. Thank you so much for breaking down the mechanics of all this today. It takes a heavy topic and makes it actionable.
It was a pleasure. It's vital information for any family to understand.
As we wrap up this deep dive, I want to leave you, the listener, with one final thought to mull over. We've spent this entire time discussing how easily an unexpected loss can derail a family today. The immediate 6-month cliff. The struggle to pay the mortgage next year. But I want you to consider the generational ripple effect. Think about what happens to the next generation's ability to build wealth when a family is underinsured. When parents rely on a generic, lazy rule of thumb instead of doing the hard math of the dime method, or when they skip coverage altogether just to save $25 a month. If your children eventually have to pause their own lives, take out high-interest loans, or drain their own early retirement savings just to absorb your unpaid debts or keep their childhood home from foreclosure, they are starting their adult lives from a massive financial deficit rather than a baseline of stability. By not spending that $25 a month on a term policy today, are we accidentally making the wealth gap wider for our own children tomorrow? Are we essentially stealing from their future financial security to subsidize our present-day streaming subscriptions? It forces you to view that monthly premium not as an annoyance or an expense, but as a protective moat around your family's multi-generational wealth.
Absolutely.
I encourage you to take just 15 minutes today, sit down, look at your own coverage, and run the dime method. See if the safety net you have truly matches the reality of your family's vulnerabilities. Because at the end of the day, you want that bright red fire extinguisher sitting quietly in the corner, fully charged and ready. You hope you never, ever need to pull the pin. But if the absolute worst happens and the sparks start flying, you will know with absolute certainty that you have exactly what it takes to stop the devastation and keep your family's house standing.